Hi, very good morning everyone. So in today's session we will discuss about monetary policy and its instruments. So first of all we need to understand the meaning of monetary policy. So monetary policy in a general sense, it is just an action undertaken by the central banks to control the money supply and to achieve the sustainable economic growth. Okay, the main objective of the monetary policy is controlling the money supply in the economy and maintaining the stability in the economy and its growth. See, monetary policy is the process by which monetary authority of a country, generally the monetary authority of a country is the central bank. In almost all the countries, central bank is the monetary authority that controls the money supply and the economy by its control over the interest rates. Now, just now I told you the main job of the monetary policy is to control the money supply and to maintain the stability in the economy. How they can control the money supply? By controlling the interest rates, they can control the money supply. So, when we discuss about a monetary policy, we must understand how it works exactly. For that monetary policy to give that guidelines, okay, to frame that policy, we have a monetary policy committee. In that committee there will be 6 members, 3 members from RBI and another 3 members from government side. It is nominated members, 3 nominated members from government and 3 members from RBI. Out of that 3 from RBI, 1 member is RBI governor. So objectives of monetary policy. Just now I told you the main objective of the monetary policy is controlling the money supply and maintaining the stability in the economy and its growth. There were some other main important objectives of the monetary policy. In that, controlling the inflation, unemployment, and currency exchange rates are very important objectives of monetary policy. Apart from controlling money supply, these are the important objectives of monetary policy. Inflation, how they can control inflation? See, inflation means what? It is a situation in economy where there is a more money supply, more money circulation in the economy. Because of more money circulation, the prices will go up. Okay, so prices will increase, demand for the product will increase. So for that situation we call inflation. That means virtually people will be having more money in their hand. Okay, and the value of the money comes down. For that condition we call inflation. In that case, what RBI can do through this monetary policy, what they will do, they will withdraw some money from a economy. That means they will pull some money back from the economy. How they can do that? If they increase the interest rates, so automatically people taking loans, it will get reduced. Okay, because of more interest, people they don't want to take more loans, so money circulation automatically comes down if they increase the interest rates. And if there is a deflation, it is opposite, they will inject some extra money to the economy. How they can inject? Just reduce the interest rates. So when there is less interest rates, people automatically they will take more loans. Okay, they will start more business. When they start more business, more job opportunities, automatically people will get money. Okay, so money will come to the economy. It is just in case of the deflation, releasing money to the economy. In place of inflation, in case of the inflation, so pulling out some money from the economy. That is how they will do. And unemployment, how they can control unemployment? Same thing. So unemployment, when it occurs, when there is no capital investments, okay, it leads to more unemployment. So they will release some money into the economy. So they inject some money to the economy. In that case, there will be more business activities, and that leads to the expansion of the job markets. That creates more job opportunities. When people get more jobs, automatically they will get income, salaries. So if they get money, so that leads to the stability in the economy, that increases the standard of living. So that is how we can control the unemployment. And currency exchange rates. So currency exchange rate also same. If there is a more money supply in the economy, so rupee value comes down. Okay. So by just increasing, decreasing interest rates, they can control the currency exchange rate also. There are some other objectives like a regulation of monetary growth and maintenance of the price stability. And this is also important. Just now I told you, by increasing or decreasing, or by injecting more money into the economy, or pulling out money from the economy, that affects the price stability and our rupee value. Correct. So for that, RBI, what they will do, they will focus on the monetary growth and the price stability. Prices should not go up. In case of the inflation, so prices will get increased. Correct. It will go up. In case of the deflation, prices comes down. So just to maintain that stability, control the inflation, deflation, that is one objective of the monetary policy. And ensuring adequate expansion of credit. So giving proper adequate expansion of a credit, giving loans for doing the business or for any other sectors. Assist economic growth. So by giving some assistance for the economic growth, that means they will give some policies, some advices, and also they will help for the economic growth by taking some extraordinary actions. Then encourage flow of credit into priority and neglected sectors. So when banks issue loans, they will direct banks to give some percentage of loan only for a particular priority sector or for a particular neglected volume of people. Then strengthening of the banking system of the country, of course, by giving some preference to the bankings, they will try to strengthen the banking systems. So these are some other objectives of monetary. Now the very important thing in this monetary policy is we need to understand what kind of instruments they use. Just now I told you monetary policy, their main objective is controlling the money supply in the economy. And also I told you how they will control the money supply by changing the interest rates. Correct. So for that interest rates, we already divided into two types. One is a quantitative method, another one is qualitative method. Okay. By using these two types of instruments, we will control the money supply in the economy and we will help to the growth of the economy through this monetary policy. So we will understand the quantitative methods, that is the bank rate, open market operation, then CRR, SLR, then liquidity adjustment facilities, then marginal standing facilities. When it comes to the qualitative methods, it is consumer credit regulation, credit rating, moral suasion, then control through the direct actions. We will understand all these things. So first we will understand the quantitative measures. In that, the first one is bank rate policy. See, very simple. Bank rate policy means it is an interest rate. Okay, interest paid by commercial banks to the RBI because they borrowed some money from the RBI. It is just like taking loan from RBI. For that loan, commercial banks paying interest. For that we call bank rate. Actually, most of the people, they will get confused with the bank rate and repo rate. So you may be knowing about repo, reverse repo. Okay, repo means commercial banks has to pay some interest to the RBI for the borrowed money. Okay, so commercial banks borrowed some money from RBI. For that, commercial banks has to pay some interest rate to the RBI. For that we call repo rate. Reverse repo means opposite. Commercial banks deposited some money into the RBI. For that deposits, RBI will pay some interest. Understand this concept. Okay. For example, if you are taking loan from a commercial banks, you have to pay interest to the bank. Correct. Sometimes if you are depositing your money into the bank, it may be savings account or fixed account, fixed deposit, bank will pay interest to you. Correct. Same logic. If you are paying interest for your bank loan, that is like a repo, commercial bank paying to the RBI. If RBI paying to the commercial bank means reverse repo, because commercial banks surplus money they deposited into the RBI. For that money, RBI will pay some interest to the commercial bank. That is reverse repo. Now you need to understand the difference between the repo and bank rate. A repo bank rate, it is almost same, but there is a difference. How it is similar? Similar because both are interest rates which commercial banks are paying to the RBI because they borrowed money from the RBI. But then what is the difference? See, in case of the repo rate, commercial banks can take loans. They can borrow money from the RBI by pledging some securities. That means you must give some collateral, any asset. Okay, by pledging some securities, you are taking loan from RBI. For that you are paying interest. For that interest rate we call repo rate. Okay, but in a bank rate you are taking loan. That means you are borrowing, commercial banks borrowing money from the RBI, but in this case commercial banks not pledging any securities, without any pledging. Okay, without any collateral you are taking loan. That is the only difference between bank rate and repo rate. Please understand this. Repo rate, it is the interest rate paid by the commercial banks to the RBI, loan taken from the RBI without any pledging, without any collateral. But repo rate, it is the interest rate paid by commercial banks to RBI for the loan taken by RBI, but the loan is taken by pledging some securities. That is the only difference. Okay. Next, open market operation. Open market operation means what? RBI directly they will sell or they purchase the securities, okay, from the economy, from the public. Why they will do that? If they think there is a more money circulation and immediately they wanted to pull some money out from the economy, what they will do? They will sell some securities. When they sell some securities, public people they will buy the securities by paying money. So all the money, it is collected by RBI. That means money goes to the RBI. If they're selling something, money goes to the RBI. That means so they can control the money supply. If there is a very less money circulation in the economy, to inject money into the economy, what they will do? They can automatically they can purchase. Already they sold some securities, they will repurchase that. They will give money to the public, then they purchase their securities. In that case what happens? Money come to the economy. That is open market. Then cash reserve ratio and statutory liquid ratio, I explained it in a last class itself. Cash reserve ratio means what? It is a ratio, some portion of amount, every bank, some portion of amount in their deposits, they must keep it with RBI. For that we call cash reserve ratio. Statutory liquid ratio means some portion in their deposits they has to maintain with the bank itself. Okay, it is like security deposits just to maintain that liquidity. So statutory liquid ratio. So these guidelines are given by RBI. So some portion out of the deposits you must keep it with RBI. For that we call CRR. And some portion of your deposit you must keep it with bank itself in liquid form. That may be cash, that may be any securities, or that may be gold. In a liquid form you must maintain in the bank itself. For that we call SLR. I explained it in the last class also. So now qualitative measures. What are the qualitative measures? So quantitative measures we use to control the overall volume of the money, okay, overall economy. But qualitative measures on particular area, we use these techniques to control the money supply on a particular area. So qualitative credit is used by the RBI for a selective purpose. That's why I told you on a particular area. So first one is margin requirements. So margin requirements here is, it is just like a difference between the securities offered and the amount borrowed by the banks. RBI they will tell you the margins. In that case what happens? Imagine one commercial bank, like a Vijaya Bank, they need to take loan from RBI. If they pledge, okay, some 1 crore rupee securities with the RBI, they will say 65% is margin. That means only 35% you will get loan. If they pledge 100 crores worth securities, they will get only 35 crore loan. For that we call margin requirements. Okay, it is all just to control the money. Next, consumer credit regulation. Of course, here also RBI gives some guidelines to all the commercial banks to increase or decrease the down payment rates, because nowadays we purchase almost everything on EMI installments basis, correct? So in case of that, if they wants to reduce the money supply or increase the money supply, they will do this increase or decrease of down payment rates. And guidelines, are they issue some oral or written statements or appeals or guidelines or warnings to the commercial banks. So every day-to-day basis they will be giving some guidelines to the commercial banks to maintain the money supply. Then rationing of credit, that means limiting the lending. Just to limit lending, that means commercial banks, they will give more loans sometimes. So limit that, control the money supply. To limit that lending, RBI controls the credit granted or allocated by the commercial banks. Moral suasion. Moral suasion means in reality, RBI requests the commercial banks now to decrease or increase the interest rates. So every time RBI cannot bring orders, correct? So in some situations, what RBI will do, RBI requests the commercial banks, please increase the interest rates, so that we can control the money supply in the economy, or please decrease the interest rate so that we can inject more money into the economy. So they will do that. So it is just a moral suasion, because in a psychological way they're requesting, that's why it is moral suasion. Then direct action. So direct action means this is a step it's taken by RBI directly to control the money. RBI may refuse to rediscount their papers, or may give excess credits, or charge a penal rate of interest over and above the bank rate for credit demand beyond a limit. See, direct action means RBI takes direct actions against the banks. If they are not following the rules and regulations given by the RBI, they will take direct actions. Sometimes they can cancel the license of the bank. They will do all these things. So taking direct action against the commercial banks, that is direct actions. So I hope all of you understood this monetary policy. I told you the meaning, monetary committee, objectives, then the instrument used in monetary policy. If you have any doubt, please text me. Thank you so much. Have a nice day.